Opendoor is having another tough session today, and the timing of this move makes it an especially interesting moment to talk about. It's about 1:30 in the afternoon on Tuesday the 18th of November, and the stock is sitting around $7.25, down something like 60 cents or roughly 7.5%. And on the surface, this is just another red day in what's now been a multi-session slide. Remember, last Wednesday the stock was trading near $9.50. It had momentum behind it, it had a narrative forming, it had a breakout look. Now we've seen it give back more than $2 in less than a week, and it's doing so into the heart of a broadly weak market where almost everything is down. But here's the thing. Today isn't just any normal down day. Today is the Warrant dividend record date. This is the day investors have been eyeing for weeks because it determines who receives the Series K, Series A, and Series Z warrants. And that means today is the moment where the structural incentive for shareholders and the structural risk for short sellers actually becomes real. So the price action happening right now needs to be seen through that lens. It's not just a random drop. It's a combination of market weakness and catalyst-driven repositioning. Let's start with the broader market, because that sets the backdrop. Markets are down again today. Tech is under pressure. Real estate names are bleeding. Macro sentiment is mixed, with traders trying to digest the impact of future interest rate moves, inflation readings, and recent economic data. When the whole market rolls over, even strong setups take a hit. And Opendoor is a high beta name. It moves fast in both directions. So a red day here isn't surprising. The important part is that the weakness today isn't coming from anything Opendoor has done wrong. There's been no negative news. No guidance cut. No operational surprise. The business hasn't changed. What's changed is that the market is risk-off right now, and Opendoor tends to feel that more than other names. Now let's talk about the warrant dividend, because this is the key to understanding today's action. If you held shares at the close of business today, you qualified for the three warrant types: the Series K with a $9 strike, the Series A with a $13 strike, and the Series Z with a $17 strike. For every 30 shares you own, you get one of each warrant. These are tradable financial instruments that give you upside leverage on the stock over time. They reward shareholders for their belief. But the other side of this mechanism is what makes today so interesting. If you're short the stock, these warrants represent a cost. They dilute you. They create risk. They force you, at minimum, to think about the economic value of the dividend you effectively owe as a short seller. So today's price action isn't just broad market selling. It's also the final hours where shorts must decide whether to stay in or get out before the record date. And that creates volatility. Some shorts cover. Others try to push the price lower to reduce the perceived value of the warrants. Some traders who bought in anticipation of the run-up into the record date take profit. Others hold and prepare for the post-date setup. So this kind of push and pull is exactly what you should expect to see on a day like this. The big question now is, does this structural setup still exist? And the answer is yes. In fact, in some ways the setup becomes even more interesting from tomorrow onward. Because the moment the record date passes, there is no longer an incentive for shareholders to time their purchases. There is no longer a reason for shorts to try and game the dividend mechanics. The next move in the stock will be based on the natural balance of supply and demand, and that's where things can get really interesting. Let's take a step back and look at the psychology at play here. Last week, when the stock was in the $9.50 range, a lot of retail and even some institutions were getting excited. The narrative was heating up. The insider buy from CEO Nejatian gave the stock extra momentum. And the hype around the warrant dividend created expectations of a possible squeeze or at least some kind of short-term price pressure. But it's important to remember that markets rarely give you exactly what you want in the exact moment you want it. If everyone believes a stock is going to explode upward into a catalyst, it almost never does. Instead, what you often see is a pullback before the event, a shakeout of weak hands, a drop that tests conviction, and then, if the setup is real, the move happens after the catalyst, not before. And we might be seeing exactly that dynamic here. The stock is sliding into the record date instead of exploding into it. And while that's disappointing for those who are hoping for an immediate squeeze, it actually fits the playbook of many catalyst-driven setups. The market forces out the impatient money first. It pulls down the price. It creates doubt. And then, if the underlying thesis is real, the next leg happens when the pressure shifts. So let's talk about that pressure. Short interest is still elevated. Borrow costs remain high. And most importantly, after today, the warrant risk is now locked in. Shorts can't avoid it now. They either stayed short and took on the risk, or they covered and reduced exposure. This means that starting tomorrow and continuing into the rest of the week, the market will show us where the real demand is. If buyers step in, whether retail or institutions or even shorts covering, the stock could reclaim some of the ground it lost. And if the broader market stabilizes, if we see even a partial bounce, Opendoor is the kind of name that moves quickly. A $1 rally here is nothing. A $2 rally is completely possible. And getting back to the $8.50 or $9 range is not out of the question if sentiment turns. But it's also important to be realistic. If the broader market continues to weaken, if macro conditions stay uncertain, or if traders who bought into the hype decide to exit after today, the stock could continue to drift lower. That's the risk. The setup is there, but it isn't guaranteed. What you're looking for now is confirmation. Does the stock hold the $7 zone? Do buyers show up tomorrow morning? Does volume pick up on green candles instead of red ones? Do option flows shift from puts to calls? These are the signs that the structural story is taking hold. For the video today, the angle that makes the most sense is to frame this moment as a turning point. The stock is sliding, yes. But it's sliding into the biggest structural catalyst of the quarter. The record date is here. Short sellers have made their decision. Shareholders have made theirs. And from tomorrow onward, the next move will tell the real story. If buyers step in, the pressure could shift dramatically. If not, the stock could continue to drift. But this is the moment where conviction becomes visible on the chart. The move after the event is often more telling than the move into it. So the narrative you want to build is that today's price action needs context. It's not random. It's not meaningless. It's not a breakdown of the long-term story. It's a moment of repositioning, a moment of structural tension, and a moment where the next move from buyers and sellers will reveal who actually controls the tape. This is the eye of the storm. And what happens next will tell us whether last week's highs were a failed push or the beginning of a much larger structural shift.